you, Zinta. I'm honored to have been invited to speak. In August, when Klaus was searching for evidence on financial inclusion and climate change, he found a preliminary publication that IPA had put out last year on this topic. He did not know, though, when he wrote to me about it, that I was in the middle of a deep dive into the evidence on financial inclusion and resilience. And this will be the first time that I present our review of that evidence. I should mention, since Zinta is the moderator for this session, that our interest in this area was actually catalyzed by conversations we had with Mercy Corps around their expertise in resilience and things that we knew about financial inclusion. That led to a joint roundtable to develop a research agenda on financial inclusion and resilience in May of this year. And the discussions at that roundtable have informed some of the policy recommendations and evidence gaps that I'll talk about today. Finally, this evidence is not new. You may have heard of some of the studies I'm going to talk about today already. But this is the first time that we're looking at them from a resilience perspective and synthesizing them with that lens. As Asala said this morning, the linkages between climate change and financial inclusion are hiding in plain sight. Great, so I'd like to start with a brief overview of who IPA is and what we do. We're Innovations for Poverty Action. We were founded in 2002, and we discover and promote effective solutions to poverty problems. Since then, we've worked with over 575 academics on 650 applied research projects in 51 countries. We work across sectors: health, education, social protection, post-conflict recovery. The Financial Inclusion Program, which I am representative of, as the name implies, focuses on issues related to financial tools and services. Together with researchers, implementing organizations, and governments, we identify key issues faced by the poor and evaluate innovative social programs to address them. Our projects are funded by a large variety of donors, including large foundations and governments. Today, I'm here to present on what IPA already knows about how financial tools build resilience to climate shocks based on studies conducted all over the world. I'll go through some example studies, the ones that I think are most relevant to this topic, but mostly I'll synthesize evidence that's backed up by multiple studies. My hope is that this evidence helps you to generate new ideas, policies, products, and services to address climate-related shocks in your countries. I'd be happy to discuss some of those ideas and how we might test them in collaboration with AFI and IPA over the course of today and tomorrow. So as Zinta hinted, some people might have different ideas of what resilience is. In the context of this presentation, I'm talking about economic resilience. And for us, it's the way that the resilience of low-income households across the world, especially in developing countries, who are disproportionately affected by adverse events, leading to a sudden loss of income or an unforeseen large expenditure. And of course, we're particularly interested in resilience to the types of aggregate shocks that we expect to affect broader communities due to climate change, such as a drought or a flood. So I've identified 4 different categories for the evidence here And my review explores impact evaluations of financial services and open research questions, as well as our policy recommendations in each of these 4 areas: increasing investment in the face of risk, reducing exposure to risk, preparing for a shock, and smoothing consumption after a shock. So this is the big overview slide. This is sort of the synthesis of everything that I'll talk about today. And this shows you, I focused on how policymakers and regulators can incorporate these findings into their national financial inclusion strategies. I'll tell you why we think the areas with the most promise for increasing resilience are offering insurance subsidies, providing credit for risk mitigating technology, reducing geographical and regulatory barriers to savings, and digitizing government payments. So first, investment in the face of risk. For low-income households without the necessary financial tools to manage risk, exposure to risk reduces the incentive to invest. According to one model, and this may surprise some of you, underinvestment due to perceived risk actually accounts for 2/3 of natural disasters' impact on well-being. So that's before the disaster happened. The anticipation of the disaster and the underinvestment due to that anticipation of risk is actually much greater loss than the disaster itself. Smallholder farmers, especially who face considerable uninsured risk and who account for most of those living in extreme poverty, often engage in low-yield, low-variability agricultural practices, with little investment in farm inputs to avoid loss in case of a weather-related shock. The evidence that insurance can lead to more productive investment is well established, though the promise of microinsurance products is hindered by low demand, and that's something that we'll talk about more. So this is from a study in northern Ghana. What's interesting about this study is that at the outset, the median farmer who participated in the study used no chemical inputs in their farming. And the researchers found that the offer of a rainfall index insurance product led farmers to make larger investments and riskier production choices than just providing them with cash. So here you see that the green column is the impact of insurance, and the gray column is the impact of cash. And the total investment, the one on your far left, was greater, significantly greater with insurance than just with cash. This means that risk is more of a constraint for farmers than capital. And if we had to make a choice between cash transfers and insurance subsidies, the insurance subsidies may have a bigger impact on investment. As with the rest of the evidence I'll present today, if this lesson is of interest to you, I recommend doing some testing in your own context. This is just one study in Ghana to see how it works there and what adaptations you would need to make. Several studies on microinsurance varied the cost from full subsidy to full market rate. In India and Ghana, farmers had very low, this is less than 20%, willingness to pay for insurance at market rates. So that's at the top left, is their willingness to pay at market rates. Their take-up is on the bottom axis, and it's all less than 20%. The high demand for subsidized insurance you'll see at the other end of the scale. So free insurance is all at the edge of the scale, and it goes up that way. In addition, both studies found that trust plays a key role in take-up of insurance. I think that this is not surprising to anyone in the room. But in Ghana, farmers were more likely to purchase insurance if they had received a payout the previous year. In Andhra Pradesh, India, households were more likely to purchase insurance from a well-known microfinance institution who endorsed the product. So what does this mean for regulators and for policymakers? For those seeking to influence farmers' production decisions, large insurance subsidies may be more effective than cash. Over time, experience with subsidized insurance may increase farmers' willingness to pay for these products. In addition, if insurers were to start with coverage of low-cost but high-frequency events that are likely to pay out something over the course of a year, the existing evidence indicates that this may help farmers, customers, to trust insurance, though ultimately insurance is best suited to high-cost, low-frequency events and should be complemented by other risk management strategies for smaller, more common shocks. What don't we know? There are some key open research questions about promising areas in insurance where new evidence would be of particularly high value. For example, could index insurance paid out at the community level cover both the direct and indirect costs of an aggregate shock? That is to say, not only the direct losses of a farmer or a business that has been affected by the shock, but the indirect losses of a business that provides inputs, for example. In addition, could this lower basis risk, the risk that a loss is not covered, increasing demand and productive investment before a shock hits? I'd be interested in hearing what Andrea from Micro thinks of these questions, as they were actually inspired by some of Micro's products in Latin America. In addition, could insurance subsidies be used to incentivize risk management practices? This ties into the next section, where I'll talk about risk reduction. Some work being done by the World Food Program and Oxfam indicates that this is technically feasible. It can be done, but it's not clear what are the impacts on farmer yield, income, or welfare. All right, risk reduction. As the previous section highlights, insurance products and other strategies can help low-income households take potentially profitable risks, like buying better seeds or leaving the village for temporary work. But how can we reduce households' exposure to economic shocks in the first place? Research suggests that facilitating investment in risk mitigating technologies, such as drainage systems to avoid flooding and drought-resistant seeds, can help stop a crisis before it starts. However, the demand for and the subsequent take-up of these technologies remain low due to credit constraints, lack of information, and behavioral barriers. Initial evidence indicates that innovations in credit and savings products have the potential to reduce barriers to financing these investments. And here I'm going to focus on the credit products. So this is a study from Kenya, and they looked at alternative credit arrangements such as layaway plans and how that could potentially help finance risk mitigating technology for those with limited access to credit. The researchers offered dairy farmers asset collateralized loans instead of requiring a sizable initial deposit or a guarantor. These loans increased the take-up of rainwater harvesting tanks from 2 to 42% and helped farmers to have reliable and convenient access to water, improving their productivity. The lower deposit requirements increased repossession very marginally, but not enough to offset the welfare benefits to customers. So what can policymakers do? What can regulators do here? One idea is to have a credit facility for financing risk mitigating technology. So as you might have a credit facility for green finance, and this could go toward a number of different things, something like the rainwater harvesting tank. It could go toward the solar irrigation pumps that Klaus was talking about earlier. We also think that there needs to be some kind of opportunity for innovation, some encouragement of innovation in these credit products to lower the entry requirements. Finally, like I was mentioning, or actually, no, I didn't get to say this. So you could also condition insurance subsidies on the adoption of risk mitigation strategies. And so not just risk management practices, but also the adoption of technology, for example, and bundling the insurance with loans. Thinking through what would need to be done from a regulatory perspective to lower the requirements for households and small businesses to invest in risk mitigation. These two ideas, ensuring the loans themselves or offering bridging loans to financial service providers to defer repayment during large shocks to increase the access to finance for risk mitigation. However, just a caveat, that these are largely implementation questions. So while I've identified these as evidence gaps for our purposes, it would be difficult to test these sorts of innovations for impact, the types of impact evaluations that I'm discussing in this review. All right, third, risk preparedness. So in 2017, the Global Findex, savings was stated as one of the top 3 sources of emergency funds for those who said that they would be able to raise money if needed. This supports other evidence that we have that says that low-income households use savings as a means of self-insurance, building up their savings prior to a shock and then using those savings to smooth consumption after a shock. However, they tend to save more through informal means, such as assets, such as livestock, which may themselves be susceptible to shocks, or cash stored informally where it is at more of a risk of theft or loss. Additionally, households face behavioral barriers that limit their ability to build up savings. The other two stated, this is just a fun fact of interest, that the other 2 sources ahead of savings that were stated were working more or their social networks. And I'll get more to social networks in just a minute. Great. So it's not just any kind of savings that would help people save for emergencies, but we see through the evidence that certain types of savings products facilitate self-insurance better than informal savings mechanisms or other types of savings. So the first is free liquid accounts. They can encourage savings for emergencies because funds are secure before a shock and easy to access after a shock. Second, simply labeling savings for emergencies can act as a soft commitment and explicitly encourages savings as a mechanism for consumption smoothing without holding those savings back in case something happens and that person needs to access their money. Finally, social commitments and support through savings groups, particularly with flexible lending arrangements, may encourage emergency savings. However, the evidence is limited, and I'm going to get to that again in just a moment. The key here, though, is that savings should be more secure than if they were under the mattress, but still very easy to access. In Nepal, for example, this access was achieved by proximity and affordability. Some soft commitments can help people who are present biased, meaning that they tend to prioritize what they want now over their future plans, save more for emergencies, without making them inaccessible once the emergency happens. So there was an evaluation of village savings and loans associations, VSLAs, in Malawi, Uganda, and Ghana. And this, as well as other research that we have on savings groups, indicated that there may be multiple mechanisms at play in how the savings groups, self-help groups, or rotating credit and savings associations, such as ROSCAs, lead to increased savings. One is that they create a socially bound commitment to save. However, savings groups tend to be, not across the board because there's a lot of variation, but they tend to be less liquid and flexible than other savings tools, making them less well suited to small but common shocks. Because for small and common shocks, we want to get the money right away, and it's happening all the time. This evaluation suggested that the savings groups improved resilience to aggregate shocks, big shocks, in this case drought, but not idiosyncratic shocks, in this case illness. So what does that mean for us? Well, like I mentioned, proximity can increase liquidity, and thus savings and resilience to shocks. This requires infrastructure to increase the density of banking branches, agent networks, and ATMs. On the surface, individual savings accounts may not seem as crucial as some of the other products we've discussed to climate-related shocks, since these accounts tend to work better for self-insuring idiosyncratic shocks such as illness. However, they are a very important part of a broad risk management strategy for households vulnerable to all types of shocks, who may be less likely to, for example, take up insurance for high-cost, low-frequency events because they really need the money for that premium for the lower-cost shocks they face all the time. So we have to think about not only the climate-related shocks that people face, but also the other shocks. And I won't dive too much into this here, as IPA has a whole separate review on the evidence around women's financial inclusion, in which we highlight the barriers that women face to account ownership, including legal and regulatory barriers, such as those to obtaining formal identification. Still, I want to highlight this for your attention because women are much less likely to have access to the types of services I'm discussing in this review. What do we need to know on risk preparedness? There's some preliminary evidence that in consumer protection, paper disclosures are pretty ineffective. In the insurance sector, there's already some providers, such as Milvic, innovating with audio, video, and SMS disclosures. I'm not aware of similar work in savings, but this could potentially increase customers' trust in the provider, so they know they can access their money when they need to. In addition, regulators may consider support to financial institutions to ensure widespread withdrawals in the case of a sudden aggregate shock, such as a flood. This intervention could increase savings before a shock if customers know about it, and it increases their trust in the financial institutions. Finally, I've discussed how the evidence on savings groups and resilience is mixed. One way to address the limits to this model would be to link groups with formal financial services for more comprehensive risk management. How can savings groups be leveraged to link members to payment services, credit, and insurance to serve as a complement to savings groups and allow members to respond to a wider variety of shocks? Finally, responding to shocks. In 2017, poor households in low and middle income countries were 27 percentage points less likely than their wealthier counterparts to report that they could come up with the funds for an emergency if required. When a negative event occurs, low-income households without appropriate financial tools may be forced to engage in suboptimal coping practices, such as cutting food consumption, reducing human capital investments, and selling productive assets. This is why we care so much about resilience. These coping strategies have a detrimental impact on welfare and can reduce income in the long run. The 2017 Global Findex survey asked respondents whether it would be possible to come up with an amount equal to 1/20th of gross national income per capita in local currency in the next month. Oh. Sorry about that, my notes are a little mixed up. So what do we know already about responding to shocks? So here I'd like to talk about digital transfers. Cash transfers via social protection programs carried out by governments or implementing organizations contribute significantly to smoothing consumption after an adverse shock. In Niger, household members who received a digital transfer after a drought experienced increased consumption, improved dietary diversity. They depleted their non-durable assets at a slower rate and produced a more diverse basket of agricultural goods, compared to households that received that money in cash instead of digitally. The researchers hypothesized that these results could be partly explained by the time saved in receiving the transfers and increased women's control over spending decisions in the household. So this is one that you may have seen already. Digital financial services can enhance the impacts of informal risk sharing by lowering transaction costs and expanding the social network able to contribute, including across borders. In Kenya, households with access to the mobile money platform M-Pesa received funds from a larger network of senders located further away and were able to absorb large negative income shocks, in this case caused by a drought, while non-users experienced a 7% reduction in consumption on average after a shock. In addition, as you see here, over the long run, 7 years, if I remember correctly, female-headed households, mainly, but there were some male-headed households as well, were lifted out of poverty, 186,000 households in total. Similar results to this one were found in Rwanda, where households were able to send money in the form of airtime credit following an earthquake. So one thing governments can do is to shift large transactions, such as regular social protection payments or wage payments, to mobile money. This would incentivize MNOs to invest in cell phone towers and widespread agent networks in shock-prone areas. In addition, with savings, bank and agent liquidity management is key to making sure that households in affected areas can get funds they need when they need them. And take up of the services in the first place, since not being able to withdraw funds from their mobile money account is likely a deal breaker for these households. There's some preliminary evidence that SMS messages to agents, helping them calculate how much money to have on hand at any given time, makes them less likely to run out. So capacity building and oversight for agent liquidity management is the recommendation there. The key question we have in this area is how transaction data and digital identities created by mobile money could be used to target government transfers or insurance subsidies toward areas with lower rates of mobile money utilization. I mentioned the study in Rwanda, where they did find that people affected by the shocks received more transfers from their family and friends. But what they also found was that people were, rather than being charitable, the senders expected to receive transfers themselves in the future, and that people who were wealthier and more well-connected were more likely to receive transfers. Other research has identified mobile money take-up as a proxy for informal risk-sharing support. So what we want to know here is how could government transfers or subsidized insurance be targeted to account for gaps in access to informal risk-sharing, networks, and digital financial services, particularly toward areas with lower rates of mobile money utilization, and what other interventions could be taken up to improve mobile money so that digital transfers are more evenly distributed. So that's all I have for now. I'd like to welcome Zinta back up, and we will go directly into the panel.
Great, is this on? So thank you, Nellie. I hope that answered a few of your questions. And we'll have an opportunity to discuss this further after we hear from two respondents. So I'd like to welcome to the stage Habiba and Michael. If you would come and sit down, and we'll have a conversation about the topic of resilience. Is Michael here from the Reserve Bank? Yes, Vanuatu. Thank you. Actually, while you come on stage, maybe Habiba, I'm not sure if you want to speak from the lectern or down here. Habiba's from the World Bank and will be speaking on the World Bank's perspective, World Bank's group's perspective on building resilience.